Hope everyone's having a good end of the year. Definitely one of the busiest ends of the years from our side. And today we're excited to talk with you guys about the challenges and opportunities for institutional DeFi adoption. So I see a lot of people joined on time, so let's just dive into it. We will be recording the presentation, so if you're not able to stay for the whole duration, you can look at it afterwards in our social media and share it as well. Today, we'll be talking about institutional DeFi. We'll start by diving into the current state of the DeFi space, then diving into the challenges ahead, and lastly, of course, the opportunities that you can look in DeFi for 2025 and beyond. So before getting started, quick update about Into the Block. So we released just now this great dashboard diving into 2024, all of the key narratives, all of the key factors that led to the growth of crypto in 2024. So of course we cover the ETFs, Bitcoin and ETH, meme coins, which have grown by over nearly 100 billion this year in market cap. We look at restaking of Bitcoin and ETH, Athena, and much more. So make sure to check that one out. We just released it in our analytics app. And then also on our risk radar product, we launched more protocols. We are currently at about 40 protocols where we have a holistic economic risk framework into DeFi. So we recently launched Mountain USDM, one of the original yield-bearing stablecoins. You can look at the slippage, the peg, the yield that it generates. And very soon we're launching also Euler V2, which we're very excited about. It's a modular lending protocol that has grown already to over 100 million in TVL within a month or two of being live. We look at whales, liquidations, lending activity, and much more. So keep an eye out for that one. And so let's dive into the main topic for today. For context, Into the Block is one of the largest players in the institutional DeFi space. We are really focusing on this the majority of our time, while also benefiting our analytics efforts from like our internal operations of hosting DeFi strategies for some of the largest institutions. And based on our experience in this space in 4 years or so, we wrote a report that is free to access for anyone out there that covers this topic of DeFi's next frontier, specifically the challenges and opportunities. So there's some overlap with that report and the presentation, but it dives deeper. So feel free to check that out if you're still eager to learn more afterwards. So first off, what brings institutions on chain? Why use DeFi after all? I see some comments in the chat, by the way. I'll keep an eye on this. Yeah, we'll have a Q&A at the end for more details. Anyways, what brings institutions on chain? The reality is, if you're a crypto native institution, most of them want access to yield and leverage on their assets. So you're a company that has been in crypto for say 3 years plus, and you have a large basket of assets, either that you currently hold or you hold on behalf of your clients. And so people look to get yield on those assets naturally. If you're outside of crypto, these institutions have less assets, or definitely a smaller percentage of their assets are in crypto. So what they really care is about the utility more than like the financial returns. So that's why you hear people like Larry Fink talk about tokenization, because you have faster settlement. So anything on like Ethereum blockchain or Solana can be settled within just a few minutes or less. Whereas in the traditional financial system, it can take days and doesn't work in the weekends or evenings. It's transparent, so you can look on chain at any transaction. No need to have any trusted party confirm. And importantly, it's also permissionless. So anyone globally can use these financial services without having to show that they're trustworthy. They have like zero barrier to entry, which is a more democratized access to finance. And these two trends, like both the returns and the utility, grow over time, but they do follow this market cyclicality, where, of course, in bull markets, a lot of the attention shifts and drives like further innovation, and that eventually drives more utility. So let's dive into where we are right now. There's three key trends in 2024 for DeFi. One is the TVL and revenue growth. So a lot of the projects that have been established for years now are facing strong tailwinds behind them, pushing them to reach new highs in multiple cases. At the same time, the competition is heating up. There's new entrants coming in. There's new use cases as well, gaining a lot of traction. So we'll dive into those two and how they collide with each other. In terms of TVL growth, the growth has been quite quick, and fast paced. So we see 100 billions in increase in value locked. This increases not just in dollar terms, but also in like ETH terms. It outpaced it, showing that there's actual inflows of capital into DeFi, and stable coins in parallel, which are not accounted in this, also increased by another 60 billion or so, I believe. And amongst the fastest chains, Solana and Base, the layer 2 on Ethereum, have been two of the fastest horses pushing DeFi forward. Then we see some of the largest protocols really outdo themselves in terms of growing their revenues. So in the 2021 market, a lot of the focus was just on attracting TVL. That has shifted to be more focused on revenue, on these protocols actually being sustainable and bringing value rather than just speculation. And so you see Aave and Lido both nearing about $1 million in revenue per day. So pretty stark growth that they faced over the last few months. And many of these are also looking into fee switch proposals, where essentially a portion of the revenues generated by the DAO would circulate back to the token, finally ending that uncertainty of the value accrual of governance tokens. Some projects like Hyperliquid already implemented this, and there's more looking into this. So there's a lot of the newer protocols that, such as Pump.Fun as well, that are doing very well in terms of fees. And in the future is expected that they'll also have a fee switch. In terms of market cap, it's good to see that a lot of the growth in TVL and revenues is being reflected in market cap. So we see here market caps of the DeFi blue chips. So within this basket, we consider Uniswap, Chainlink, Aave, Compound, and a few more. That is back to the highest it's been since early 2022, reaching yearly highs just this week. So blue chip DeFi is back. The whole DeFi renaissance trend seems to be definitely panning out. And we also see the new tokens such as Athena, Hyperliquid, and a few more trading at quite rich valuations. So we do see increased competition in this space. On the lending vertical, we see Morpho, Spark, Camino, and Euler as relatively new entrants. Morpho was already around in the last cycle, but they were an aggregator of lending protocols. Now they have their own lending protocol. I believe they're at $1 billion in TVL. So is Spark, which is like a sub DAO of MakerDAO, now called Sky. Camino on Solana has grown quite a bit. So there is a lot of new entrants that are pushing to get, a portion of the pie as this grows in the bull market. Then in the DEX space, we see Aerodrome in particular shine on Base, where they've been on multiple days the exchange venue with the most volume for tokens like CBBTC. And I think even in general, they might have been the top venue for one day. And Radium on Solana has really shined with meme coins, becoming the de facto place where those are traded, and Jupiter aggregating those on top and really gaining share in that manner. On derivatives, on the derivative space, we see Hyperliquid eclipse DYDX, as we'll get into further, and Jupiter also launching their own derivatives arm that has outcompeted in the Solana ecosystem. On staking, we really see this new, adjacent version of staking, liquid restaking, pushed on top of EigenLayer, where stakers get exposure to other applications, not just like validating Ethereum, but also providing security to this whole ecosystem of actively validated services, AVSs as they call them, in order to get extra yield. So we'll discuss these mechanics a bit in further detail. So that's the first one, like the first vertical that has seen a lot of competition in 2024 is liquid staking. So we see here in the graph in the left, the share of TVL that's in liquid staking has dropped from nearly 30% to 20%. So not that big of a drop, but it's pretty noticeable given that it had been in a very strong uptrend up until 2024. And then in 2024, Q1, EigenLayer starts increasing caps aggressively of how much can be put into EigenLayer. And a lot of the capital from liquid staking gets shifted into liquid restaking, which initially was just a points farm. But now in Q4, we're actually starting to see applications be secured by these liquid restaking tokens and pay out extra yield. So that extra yield basically means that you can get on wrapped ETH from EtherFi, you can get 4.2% versus in Lido, wrapped staked ETH, you earn about 3%. So naturally, people are now gravitating increasingly so to using leverage restaking tokens as collateral instead of liquid staking. And since they have a higher yield, you can effectively afford to borrow at a higher cost and price out people that are doing leverage staking or other strategies against liquid staking tokens, which is why here in the graph on the right we show the very quick growth that wrapped ETH from EtherFi has done and eclipsed wrapped stake ETH, which had for a long time been the largest collateral asset in Aave. Then similarly, we see competition in the stablecoin arena, with Athena being the new participant and the one really making shockwaves across DeFi. So they've eclipsed Maker as the third largest stablecoin. SDAI was the first yield-bearing stablecoin at scale, initially passing like the treasury's yield to users plus a bonus from like their operations, that the earnings that they make from loans. That yield, however, has been significantly lower than Athena's yield. Athena's yield, for those that are not aware, comes from them doing the carry trade arbitrage, where effectively they go short perpetual swaps, earn the funding rate, and go long spot to be market neutral, and earn the staking rate in some cases on that long position. And this has allowed Athena to have 20% plus APY, essentially arbitraging that market inefficiency of, when the people tend to go long, they don't mind what they're paying to go long, and therefore it creates that yield opportunity that is paid out to people holding SUSDE. And they also had another layer on top where USDE earns points for further expanding the supply. And we see here SUSD has grown to about 3 billion and USD to 5 billion, with an increasing amount of that USD being staked, essentially showing the market is now preferring actual yield instead of points. In the derivative space, we have seen a lot of competition. Historically, it's been one of the most fragmented spaces. So we can see here, the amount of players in the space. DYDX was dominating in 2023, but really in 2024, we saw GMX get traction at a point. We saw Gains protocol also do well at a certain point. But since April or so, since Q2, Hyperliquid's growth has been noticeable. They now command over 40% market share. And of course, they did recently their airdrop. They've been one of the few projects to keep momentum. post airdrop. So they've developed their own community, and it seems like, they're doing quite well now in terms of volumes and fees. We'll see if that's enough to be a sustainable advantage. But at the moment, it does seem like people are like these entities are trading places, and Hyperliquid is now the new king in the DeFi derivative space. Now that we've discussed where we are at in DeFi, let's dive into the challenges that succumb the industry over the past few years, where we are at now, and how we confront them to see further growth ahead. So clearly, there has been a regime of regulatory uncertainty in the US. Thankfully, this is poised to improve in 2025 and beyond, with Gary Gensler being out and a more pro-crypto administration coming in. So the whole regime of regulation by enforcement and creating that fear for DeFi protocols to deploy, thankfully seems to be behind us. Hopefully seems to be better in the path ahead. So the US should be encouraging more crypto adoption, and DeFi will definitely benefit as a result. Then in the EU, we had the MiCA regulation for stablecoins. That seems to be making it difficult for a lot of the stablecoin issuers to register. Only Circle so far has been able to register. Exchanges have had to delist DAI because, being a DAO, it's not clear who should register. So it's likely that the EU will continue falling behind on DeFi. And then in Asia and the Middle East, they had a bit of a regulatory advantage until today, as they do encourage more experimentation and innovation in DeFi. We'll see if that advantage, that regional advantage, continues, or if we do see like two separate ecosystems between the US and Asia. So beyond regulatory hurdles that had been casting these clouds on the industry, we also see naturally some difficulties for institutions to use DeFi. Part of it is, the whole notion of holding your own assets is foreign to traditional institutions. So DeFi is the only space rather, that allows people to hold their own assets. And they're also by default liable for that, which is a risk that poses in many institutions' mind. So multiple of these institutions trust, as a result, entities like Fireblocks or Anchorage to custody their assets. Some are more non-custodial than others, but these enterprises move slow. So therefore, it means that institutions are not able to access the whole scope of DeFi. Many institutional custody providers didn't support Solana or Layer 2s until recently. Some of them still don't. So naturally, it takes longer for institutions to adopt DeFi because of this. Though there's some tailwinds now in our favor, now that regulation makes it more clear, should make it more clear what types of regulations are acceptable and not for these large institutions to operate on chain. And other than that, of course, there's also a natural learning curve for these institutions to go on chain. It typically takes 5 to 10 steps to go from, fiat to deploying capital on Aave. That is getting easier and easier. It's faster now than ever to deploy capital on chain, bridge it, and on the same day do some actions in DeFi. So that will allow the speed that DeFi institutions access DeFi to accelerate in the near future. The other factor is risk management. This is a challenge for a lot of institutions that frankly don't know how to approach DeFi. We talked to a lot of crypto native institutions, and some of them know more than others in terms of, okay, maybe you can get liquidated here. There's a chance of depegging of this stablecoin. But this is a bit more foreign again for traditional finance institutions. So essentially, this new stack creates a new set of risks. So it's worth A, educating. This is again part of the learning curve and it'll take time. But B, we're very bullish on automation actually simplifying risk management for institutions such that they don't have to worry or don't have to be at least overly concerned about the risks of DeFi. And being programmable, the good thing is, you can automate a lot of the risk management and sort of wrap it around, curate this safeguarded approach for institutions to access DeFi, which is what we do at Into the Block, and why we think this approach should enable a much larger flow of institutions into DeFi. So now that we discussed some of the challenges, let's dive into the opportunities that crypto and DeFi specifically will have in 2025. So the first trend that we see is the likelihood that winners will continue winning. The reason being is DeFi has network effects to capital that are also present in the traditional finance ecosystem. As the old adage goes, liquidity begets liquidity. And this is the case because, one, it shows trust. It shows that institutions trust the largest players, and therefore that makes it more acceptable and less of a risk for them in their mind to deploy capital into the largest players. So by default, that's why Aave, which has been the largest lending protocol for 2 years or so, has continued growing. You see the market share in 2024 of Aave went from like 25% to 45% or so. A very significant growth, even while also facing competition from new players. So as more institutions start playing around on chain, it's very likely that they'll begin by using trusted names. Aave for lending, Uniswap for DEXs for trading, and especially for Uniswap's case, they even own the wallet, the Uniswap wallet, which has hundreds of thousands of downloads, making it easier for them to be closer to the user and therefore use their product, their DEX by default. Moreover, they're also launching their own chain, which is like at one step further with their L2. But yeah, there are different approaches that both end up benefiting the winners, at least over the foreseeable future. And then there's also clear winners in these new verticals that we discussed earlier. So we see liquid restaking, where EtherFi has taken the lead. We see the basis trading meta, where Athena is the undisputed king there. And then Pendle for yield AMMs also has a huge lead over similar products. So other than opportunities within the current market leaders, we also see this connection, coalition of sorts between the traditional finance system, the centralized finance ecosystem, both of them connecting through DeFi. So Athena is already, for example, connecting DeFi and CeFi, where they have funding rate arbitrage on centralized exchanges, and they, in a way, import that yield on chain, democratizing for anyone to access it. And now the next step is also bringing that yield to traditional finance. So there is a likelihood that more traditional brokers will, for instance, deploy into Athena or also into like DeFi. And since DeFi protocols already have access to SUSDE, those yields will converge across the board, and it creates a massive opportunity because, of course, the borrowing costs in TradFi are much lower than in DeFi. So it essentially means capital can get borrowed cheaply in TradFi and deployed into DeFi, which results in further growth for DeFi. Tied to this, Trump, or at least, a name is being linked with World Liberty Financial, which is a lending protocol on building on top of Aave. So they will have their own custom instance. They're deploying this in Q1 and already, getting set up. And it's likely that this will help create an element of trust for like more traditional institutions that want to start playing around in DeFi to do so in this sort of walled garden. It isn't fully closed, but it is, it'll have a limited number of collateral assets. I believe it's only 4 or 5 tokens, and start allowing new capital flow into DeFi. Similarly, BlackRock's BUIDL fund has been the first large experiment of real world assets being tokenized, where entities get access to the treasury yield. That has been coming down in Q4 as treasury yields decayed. But what we see is real world assets expanding beyond treasuries to more assets. So stocks, dividends can be, for instance, be automatically distributed for stocks on chain. And we eventually see real estate also coming on chain, though that will likely be towards the end of the decade. And these connections between the DeFi Legos and the traditional finance will likely make it in a synergistic way that will continue growing DeFi over the next few years. The other opportunity that we see is the embracing of app chains and chain abstraction. So on one side, we see Hyperliquid really thriving with their app chain model, where they spun up a Hyperliquid chain. Initially was on top of Arbitrum, now it's its own chain, and really managing all the layers of the stack. DYDX also did this previously, but on Cosmos stack. And this encourages a whole ecosystem of applications to be built on top. So now they have a whole set of builders building new applications on top of Hyperliquid rather than them just themselves being an application. And therefore, we see the valuations expand from being like an application to an infrastructure level valuation, which is usually an order of magnitude greater. So therefore, we expect this trend to continue, and the applications that successfully transition from being just an application to an infrastructure play will likely continue seeing some growth ahead. Uniswap with the Unichain launch is one that is definitely the market is paying attention to on that trend. And then as we see, the proliferation of a multi-chain world, we also see the need for further abstraction for this model to flourish. And multiple wallets are embracing this. So you can see on the left, like the current status of Web3, where it's like multiple chains, multiple protocols, a lot of complexity. The end goal is we'll have, the user and institutions in particular that might not be aware of all of the complexities, just say, I want X yield on this protocol, and I'm willing to risk like this percentage of my portfolio, etc. And that gets automatically deployed through a vault across chains. I think we're heading in that direction where a lot of this is abstracted. On the retail side, Infinex is doing this for users. And on the institutional side, it'll be more likely through vaults, which are increasingly popular in the market. The last layer that's even more experimental, it's an abstraction of the deployment itself, and it ties into the whole AI meta, which is the use of agents, economic agents in particular, to be able to get yield or even trade on your behalf. So the most popular of these frameworks for agents have been ELIZA, which became the largest, the most forked GitHub repository last month, or earlier this month rather, and on Base Virtuals, which is a platform for spinning up your own agents. These agents at the moment are very limited on what you can do. It's essentially like connected to a social media character system, and it has like some element of memory and can interact automatically with people on Twitter and on other social media. And it can take actions based on like feedback they receive from the market and also like on-chain data. So essentially, right now, they're currently glorified trading bots, what we're seeing with these first wave of AI agents. But in the future, you can envision these becoming the next generation of robo-advisors like Betterment or Wealthfront, but in a way that, in your phone, you can just say, okay, I have my cash, my dollars, I would like to get 10% yield on this given X parameters. And you can, route it through an agent that will divide that across a segment of protocols. That is still very far off. And I think it's very unlikely that institutions will embrace this early on, because there's this inherent risk that, okay, if the AI loses money, who do you blame? You can kind of blame the developer, but it's also like a regulatory unclarity. So it's very likely that retail will continue embracing this over the next year or two. And eventually, as the market settles and the AI mania comes down, I think institutions will start playing around with agents more and more for DeFi. To conclude, the DeFi renaissance is real. We're seeing growth across the board. The market cyclicality is likely to continue improving as these tailwinds push DeFi and the broader space in 2025. Blue chip protocols like Aave, Uniswap are likely to continue to grow, but they're also facing competitions from new use cases, like we mentioned for liquid staking, for example, seeing a bit of a tougher competition. We are likely to be on the precipice of overcoming a lot of the regulatory uncertainty, and a lot of the usability hurdles are also being improved on. So it's very likely that we'll have institutions deploy more and more into DeFi because of this. Experimentation will likely accelerate. The whole worlds between DeFi, TradFi, CeFi will collide even more. And that will create some risks, but also, of course, open up massive potential for the industry that we believe is on track to reach the trillions in assets on chain by 2030 plus. Thanks everyone for tuning in. Hope you guys enjoyed reviewing the webinar. Make sure to sign up for the next webinar. We'll be talking specifically about that last topic I mentioned of the intersection of Web3 and AI. We'll be talking about what's real, what's not, demystifying some of the hype. Our CEO, Jesus, will be taking that, so make sure to sign up. And I'll be sticking around for questions for a few minutes now. So if you guys have any questions, I forgot to mention it earlier, feel free to put them in the Q&A and the chat. I see some people thanking me. Thank you guys. I see the first question here from Kid Dora. Can we witness Sol overtaking ETH in this cycle? It is a good question. And unfortunately, I don't have metrics on this in this slide deck. But I think there's a few metrics where they've already overcome ETH. So they are generating applications in Solana, have been generating more revenue. They are also getting more users because it's cheaper to transact. So in many metrics, Solana is already beating Ethereum. The one metric that I don't think they will surpass them on this cycle is TVL, and most likely market cap neither. The reason is a lot with what I had to do of with what I mentioned of the winners winning. And this applies not just to the protocols, but also to the chains, because whenever new institutions are entering the space, they won't start with what's the riskiest or what has had issues. So Solana infamously has had outages, and even though they haven't happened in a while, institutions are naturally more skeptical of Solana than using Ethereum, which is why BlackRock BUIDL was initially launched on Ethereum, and PayPal PyUSD was also initially deployed on Ethereum. So I think that trend benefits the current winners because of that trust and that whole battle-testedness. So I don't think we see it this cycle. But if Ethereum doesn't catch up in terms of scalability, there is a risk longer term, in my opinion. More questions. How many institutions deploy capital into DeFi today? That is a question that is very hard to measure, unfortunately. But from what we see in terms of like the dollar value, it seems like there's in the thousands of institutions, either large whales or institutions that are deploying 1 million plus into DeFi. And the good thing is this is getting more diversified. So a good chart that maybe I can load up is the Aave whales concentration, where that has been going down and down as essentially more addresses and whales get into DeFi. So here you see, Aave v3 used to be basically whales when they launched, and now it's more diversified user base, meaning that there's likely multiple small institutions deploying into Aave at the moment. Percentage wise, so if I had to put a percentage, it used to be like only a handful of institutions. Now it's multiple smaller institutions. And retail does have a share, but I would say, finger in the air, retail is probably less than 50% of assets, though of course, much more in terms of users. I see a lot of people thanking me. Again, thank you guys. Hope you all have a good end of the year. And I think we'll wrap it up at that. Yeah. Thanks, everyone. Hope you guys have great holidays, and we'll see you next year.